Well, bonjour. I'm practicing my French because I'm going to be leaving on Sunday morning, bright and early, for Saint Martin, where they speak French and English and Dutch. So we're looking forward to having a few days off. And as a result, I've decided that rather than have the live webinar on Monday, I'd record this on Saturday. So it's Saturday, November 20th. That's how the time flies. Before you know it, it's Thanksgiving. And then before you know it, it's Christmas and Hanukkah. And before you know it, it's the New Year. So time flies when you're having fun. And you got to say we're having fun in the markets for sure. But at the same time, it's a roller coaster, emotional roller coaster is always something to worry about. The big issue right now, it's been around for a little while, but I think the inflation concerns are mounting. I'm more concerned. It's certainly nobody's really talking about inflation being transitory anymore. The word persistent seems to be the new adjective for inflation. And so far, nobody's really talking about permanent inflation or the kind of inflation in terms of length and the level we've got to in inflation back in the 1970s. Well, actually, I am talking about it. I've been talking about the roaring 2020s, which would be an ideal scenario for the rest of the decade, with productivity making a big comeback, keeping a lid on inflation. And the alternative to that is the great inflation of the 1970s 2.0 all over again. And right now, the great inflation is, the data certainly supports that more than it does the roaring 2020s. But hey, we still got quite a bit of time here between now and the end of the decade. And as I've said before, it doesn't have to be one or the other. It could be the great inflation here for a little while. And then before you know it, things will calm down and productivity will make a comeback. And then we'll be looking at productivity-led economic growth, which should keep a lid on inflation. But for now, we have to be realistic. We have to look at the data as it comes in. So let's have a look here. Let's go to chart package for Monday, and some of you will get it on Sunday. So here we go. So first of all, let's take a look at this chart. I think this first chart makes it pretty clear that the reason we have supply chain disruptions is first and foremost because of a demand shock. Fiscal and monetary policies around the world, but particularly in the US, somewhat in Europe, somewhat in Japan, somewhat in China, they've all been too stimulative. And a lot of, I think the US has kind of led the way with monetary and fiscal stimulus, and a lot of that stimulus has leaked overseas through our trade balance as we import more. And as you can see, the 12-month sum of inbound containers coming in from the West Coast ports has soared to a new record high. And I don't think the ports were ready for that kind of awesome demand. So people got a lot of money in their pockets as a result of the lockdowns, as a result of 3 checks, as a result of the Fed buying bonds in the market. Deposits went up, M2 went up, and people have been buying a lot, and quite a significant amount has come from overseas, particularly China. And so hence we know why these container ships are bobbing up and down, waiting to unload in the LA ports. You can see that this is a pretty good indicator of overall inflation adjusted imports. But I would say that the blue line is certainly supports the idea that the supply disruptions, the supply shocks started out and continues to be a demand shock, because after all, Congress just passed Biden's first go round of spending. What's actually the second go round. The first go round was the $1,400 checks earlier this year. He's even admitted that that was a source of booming demand that's caused inflation and caused the supply disruptions. But the second go round just a few days ago was Congress passing the Build Back Better infrastructure bill, which is going to be interesting to see where we're going to find the workers that we need to do all that, and the materials as well. And then, of course, there's another round of the Build Back Better spending plan on the social side, which even if it were to pay for itself with taxes, the fact of the matter is it's going to be a lot more spending. It's going to put even more money in people's pockets. So that's all potentially more of a demand shock that will continue to disrupt the supply side of the economy in a more persistent fashion. And I think there's lots of us who hope that the supply disruptions will be resolved by the middle of next year. I'm in that camp. But on the other hand, talking to some company CEOs in manufacturing just the past few days on some conference calls, the feedback I get was this mess is gonna last through the end of the next year. So if the supply disruptions persist through the end of next year, inflation will persist through the end of next year, most likely. So our forecast, this is not a new forecast, but it's relatively new. Over the past couple of weeks, we've been kind of putting our forecast in a graphic representation in this chart. So here's the total consumption deflator. We might as well look at the total. I mean, it's a real cop-out leaving out food and energy, since that's what people spend a lot of their budgets on. And to the extent that the supply disruptions and shipping and trucking, and that the labor shortages are contributing to inflation in food and energy, there's not much point taking them out, since they are very much part and parcel of the problem. And by the way, they're deja vu all over again, very reminiscent of what happened in the 1970s when food and energy prices soared and got into cost of living adjustments. Before I forget, speaking of cost of living adjustments, they're back. The big manufacturer of farm equipment and construction equipment, just settled with the 10,000 United Auto Workers, and it's got some pretty hefty increases and bonuses and retirement package improvements. But the thing that caught my eye is there's a cost of living adjustment clause in there for every 3 months. So every 3 months, every quarter, there's going to be an adjustment for the cost of living, irrespective of what productivity is doing. And that's deja vu all over again with the 1970s, where the cost of living adjustments contributed to the wage price spiral. So it's another concern on the persistence of inflation. So here's our scenario for persistent inflation, 4 to 5% range. We're already in there at 4.4%. Maybe it could jump above that. The CPI total was 6%, but the PCED doesn't give as much weight to rent, and there's other differences. But it could very well in October be at the top of the range here. We think it stays in this 4 to 5% range, and then we think it starts to settle down by the second half of next year. So we do think that some improvements in the supply disruption problems will take some of the pressure off of all these prices. In addition, there's been a lot of pent-up demand and discretionary demand for goods that is being satisfied, continues to be satisfied. At some point here, I think people are just going to be exhausted in doing all this spending. But then again, I'm the one who keeps telling you that Americans are born shoppers, born to shop. So now we're looking for this thing to moderate to 3 to 4%. That's obviously above the Fed's 2% official target. But as we've said a few times of late, we will not be surprised if 3% becomes the new 2%. That becomes the new official target. Let's move on here. So we're monitoring inflation very, very closely. Debbie and I and Melissa and Jackie and Molly, all of us. So here's the data we have so far for 3 of the 5 business surveys conducted by the Federal Reserve district banks. So we don't have Dallas yet, but we do have Kansas City Fed. You can see that it's remaining. These prices paid and prices received indexes are staying quite high. We've got the New York Fed, ditto. They haven't come down. And keep in mind, this is a diffusion index. The participants are asked, are prices higher, the same, or lower as the month before? And if they were to say it's the same, and more and more of them said we're the same, it's as high as it was last month, but it's the same, then you'd actually be starting to see this thing coming back down. But a lot of them are saying it's higher. So that's what's keeping things elevated here. And then, of course, Philadelphia came out, and they actually had a new, it looks like a new high in the prices received. The prices paid also up in record high territory. So we put the three of them together. Molly did this for me. And you can see this is the prices received, prices paid for the New York, Philadelphia, and Kansas City through November. And again, the prices received, that presumably is not something that the consumer sees until those prices received gets pushed up into prices paid, which is what we pay as consumers. And so they're all still very elevated. There's no kind of sign that this is kind of turning down and that it's a transitory problem. Right now, it's persistent at these kind of levels. We also watch the regional surveys data for unfilled orders, delivery times, and backlog of orders. And so again, we've got the three of them through November. And it's kind of a mixed bag. The blue line is New York. It's still quite elevated in terms of delivery times. It still takes a long time to get deliveries. The green is Kansas City, and that's actually come down quite a bit. But again, these tend to be pretty volatile, which is why we try to look at all of them. We're not even going to average these together at this point. I don't think we did that. No. But you can see the blue, we did that. Philadelphia is red, and that came swinging right back. So whatever we got easing off in Kansas City was offset by things remaining quite tight or going even tighter in Philadelphia. Then Fed officials, incredulously, some of them have been saying that, well, inflationary expectations still remain well anchored around 2%. Fed Vice Chair Clarida said that last week. It's like, I don't get it. They have some sort of indicator that I think is a mishmash of about 6, 7, 8 components. And there's surveys, which is fine, but they seem to be surveys of professionals rather than just asking people on the street. There is a survey that's not included in there that actually is conducted by, guess what, the Federal Reserve Bank of New York. And that certainly looks more consistent with what we're hearing in the evening news, what we're seeing when we go into the stores. The 1 year ahead expectations is 5.7%, and the 3 year ahead expectation is 4.2%. Again, all of these things certainly not well anchored around 2%. This thing never really was well anchored. It was really more well anchored around 2.5%, 3%, but now we're well above that. So, you know, there are already, I think, a couple of Fed officials saying maybe it's time to think about tapering at a faster pace, implying that we need to get this thing going because if we're going to be raising interest rates to fight inflation, we got to get the tapering behind us. They set up these rules. I mean, there's no particular reason that has to be. But then again, I guess they don't want to shock the financial markets. They're really into communicating what they're going to do and giving us lots of lead time. The problem with that is inflation isn't going to wait for them. And to the extent that they are behind the curve, that's just going to make them more behind the curve. So I guess everything I'm saying suggests that the inflationary risk remains to the upside relative to even our forecast. Here's expected inflation and the spread between the 10-year nominal bond yield and the TIPS yield, the comparable TIPS yield, and that's at 2.65%. I'm sorry, I just don't believe this number. First of all, keep in mind that the Fed is rigging the TIPS market. It's gone from doing not much in the TIPS market to buying quite a bit in the TIPS market. So this is what the Treasury has been issuing in TIPS and notes and bonds. Here's what the Fed's been buying, and this is pretty significant. Over 20% of the TIPS now, notes and bonds, are owned by the Fed. So that I don't really know what that spread between the 10-year and the nominal and the TIPS yield really means, especially given that it's being clearly impacted by Fed intervention. So here we are looking at the personal consumption expenditures deflator. It did a pretty good job of hitting their 2% target before they set the target way back here in the 90s and the early 2000s, well, through the 2000s. And it's pretty well recognized that the Greenspan Fed and the Bernanke Fed, while they didn't put out an exact number, they were thinking about 2% as sort of the right level. And then ever since the Fed went official on 2%, haven't had it. They've barely made it more than a few times. And here we are now with them overshooting, saying that they don't mind an overshoot because they've undershot. So overshooting kind of catches up with a miss here. That's a weird argument. It's this average inflation targeting approach, which makes no sense as far as I'm concerned. If you missed it here, you missed it here. Don't try to overshoot here on the upside, which again is something that you can see whether you look at the PCED with food or without food. Well, we're all noticing inflation as we're going to the store to buy provisions for Thanksgiving. Thanksgiving is my favorite holiday. You don't have to buy anybody presents. You just have to get together with your relatives and enjoy a good meal together and just relax. So it's a very enjoyable holiday. It's a great concept, giving thanks. We at Yardeni Research give thanks to you folks for having an interest in what we do for a living. I do thank you for that. All of us at Yardeni Research, thank you for that. Hope you have a great holiday. And we will have the morning briefing out on Monday and Tuesday. Then we'll take a few days off. And then should be back on Monday if I'm allowed to get back into the United States of America, depending on all of these COVID regulations and so on. But again, I wish you folks all the best, happiness and health with your families. Thank you very much.